Hello, everyone. Welcome to the webinar. We're going to give people about 2 to 3 more minutes actually before we get the webinar started, just in case they're running late. So just sit tight, and we'll begin in about 2 to 3 minutes. Hello, everyone. Welcome to the webinar. We're still waiting on a few more people to show up. So it's 1 o'clock now. So we're going to get started at 1:02. So in exactly 2 minutes, we'll get started. So sit tight and, get ready. Okay, everyone, we're going to get started. So I just want to introduce myself. My name is Brian Griffith. I'm the digital marketer here at Greater Alliance, and I'm going to be introducing Stacey Realo in a second. But welcome to the Getting Your Finances in Order Before You Buy a Home webinar. This is going to be a great presentation if you're in the market to buy a home or thinking about to, or if it's something down the line that you're going to do with your spouse or your family. So, get ready for a nice fun fact filled presentation. And with that, I'm going to introduce Stacey. Stacey Realo has been working with Navicore Solutions for 13 years, being a housing counselor and giving financial education to individuals and families looking to buy a home or sustain home ownership. Previously, Stacey has worked with the mortgage origination before becoming a housing counselor. So basically, she has a lot of experience in this industry, and I would highly recommend you at the end of this presentation, we're going to have a Q&A to ask questions because you're not going to find too many people who have more industry knowledge than Stacey. So with that, here's Stacey to continue the presentation.
Okay, thank you everybody so much for taking time out of your day to join us. If I'm meeting you for the first time, thank you for joining. If I've spoken to you before, welcome back to the educational component here. So we're just going to get started with what a credit score is all about. And some of you may have done research already in regards to preparing for this next phase or this new phase in your life. But we do want to just get started with the basics because this is one of the major components that the mortgage company will look for when it comes to qualifying you for the loan. So your credit score is a number. It's calculated based on information in your credit report that lenders will use to assess the credit risk and the interest rate they will offer you if they agree to lend you money. So what does that mean? Well, the FICO score is typically the model that the institutions are still using to lend mortgages, okay? And the range starts anywhere at a low of 300 to a high of 850. And I believe that the FICO model just enhanced that score to now be 900. So there's quite a broad range. Most lenders will require that you have a minimum 620 credit score or above. And there is a part of your credit score rating that involves a breakdown, okay? So you've got this pie chart here with the credit score breakdown. There are percentages listed, and you can find this information as well on FICOscore.com if you wanted to go online. But right now, we're just going to look at this pie chart together. So we've got the credit score breakdown being the payment history. We've got the amount owed, the new credit, the length of credit history, and the types of credit used. I would say that payment history, as well as the amount owed, that is going to be the biggest part of how your credit score is compiled. And if you decide to have a one-on-one meeting with me, which we will table for now on how to schedule that, we'll be able to personalize and get you in a position, if you're not already there, so that you understand exactly how to become credit worthy for the mortgage companies. Greater Alliance, of course, being one of them. So the reason why we have this credit score breakdown is just to show you the components of how the mathematical equation is computed. Why is good credit important? Well, nowadays, credit is most likely pulled for many areas that you are trying to accomplish when it comes to your financial needs. So whether it be to rent, maybe to rent a place, or to purchase a home, possibly even to rent equipment, or to buy something that you might need and you're looking to get financing. So you're going to need credit for that. Credit is also a good indicator of your credit worthiness. You'll hear me talk about that. Now, certainly credit does not define you, but it does allow the lender to identify where you fall within their lending criteria. So depending on what you're going for, and in this case, we're talking about a mortgage, there's a tier scale that they use. So there's going to be a low end and a high end. The stronger and the higher your credit score, the better interest rate you're going to be able to obtain. The average credit score, or the lower it is, you're going to pay a little more for that particular mortgage product when it comes to the interest rate being a little bit higher. So we use credit to buy a home, to lease a property, to also obtain insurance, whether it be homeowners insurance or car insurance at a lower rate, and to establish utility services in your name. Credit is also used for job employment applications. So credit is a big part of the world nowadays, and is very much viewed when you're applying for all different types of financial and even personal goals. Apologies, guys. The mouse is a little quick for me here, so I'm getting used to it. So tips to improve any, we'll say, blemishes or not so great remarks on your credit score. As a consumer here, I can speak of for New Jersey and for most states, you can obtain a free copy of your credit report from each of the 3 agencies, Experian, Equifax, and TransUnion, once a year. Now, you don't need to pay for your score. You would simply just obtain a copy of the summary. The summary is going to outline what each credit agency is reporting. So Experian, TransUnion, and Equifax. You want to make sure, being the consumer, and this is your credit report activity, that there is accurate information on there. And if there is not, you have the opportunity to dispute that. You can dispute it with the creditor directly, and or you can dispute it with the credit agencies directly. And they have 30 days to get back with you to hopefully resolve that dispute, update your credit report so there is accurate information reporting. I'll give you an example. I recently put in an application for a loan, and the lender put in my name incorrectly, so they misspelled it. So when I double checked my credit, as I'm entitled to once a year for free, I noticed that my name was spelled wrong. I had an alias showing up, and I certainly did not want an alias to be on my credit report. So I simply called over to TransUnion's 1-800 number, if you can believe it, on a Friday night at 8 p.m. Eastern Time. They were still there. And I identified this to the representative who picked up the phone. Now, I did hold a little bit of time waiting for them, but as soon as they got on the line, I have to say the experience was quite well. They immediately corrected the misspelling of my name because they can clearly see that it was inaccurate. I've been in the credit report world probably for 20 plus years now, okay? So they did identify that it was inaccurate, and they removed it right on the spot. And then I received confirmation that it was updated and corrected. So that made me feel really good that it was a pretty easy process to go through. Especially, I didn't even take the time to write a letter or dispute it online. I just simply called and spoke with a live agent who assisted me. Another part of improving our credit score, we want to make sure we pay our bills on time. Any bills that report to credit, that would be, for example, a student loan, a car loan, a mortgage, a credit card, a personal loan. Those are just some examples of loans that report on credit. And if we pay on time, that is really the best way that we can establish a good credit file. Now, there are times that we do fall into hardship, and that's understandable. But unfortunately, credit doesn't have any empathy, okay? And let's say you unfortunately had to pay your bill late, and now there's a 30-day late on your report. Well, depending on the other activity going on, meaning the other types of accounts, how you're using them, how much debt is owed, is going to be dependent on how many points you lose from that 30-day late. So I'll give you an example. I have seen clients lose 30 points from one 30-day late, and those 30 points are immediately lost. Those 30 points are not gained back as quickly as they are lost. So it is imperative that if we can manage our funds appropriately to prioritize our bills, it is imperative that you keep those bills on time, because as you just heard, a 30-day late can be pretty detrimental, and it could take months to recover those, we'll say, 25 to 30 points that you might have lost. We want to minimize outstanding debt. And the best way to use credit, if you don't already know this, is to use no more than 1/3 or less of what's available to you and pay it off at any given month. So if we have a $300 limit, we divide that by 3 on our calculator, and we should not be using more than $100 or less and pay it off every month. You do not need to leave a balance on your credit card. You just have to keep using it. You have to keep using it conservatively, and you have to pay it on time. The longer you do that, the more points you will gain over the years. It's when you stop using credit that your credit can become stale, I'll say, and you're not going to really gain those points. You probably won't enter the 700s. You probably won't enter the 800 score range. You'll probably be in the average or below average range. And I don't know about you, but when I go for financing options, I want the best deals. So we have to be above average to get the best interest rate options. You want to open new accounts only as needed. Easiest way to explain this is if I'm going to open up a store credit card, I'm probably just going to do that maybe once or twice a year. That would be my opinion. I tend to be conservative with that because I like to leave room just in case something else comes up in between that I need to take advantage of with a financial solution when it comes to loan options. So I want to minimize those applications I'm putting in. Now that's probably for somebody with a long credit history that I have. Somebody that's establishing credit, well, you might need to open up a couple accounts within 1 month. It's just going to be dependent on where you are with your credit at the time of you looking to not only build it, but also rebuild on it if you're looking to establish from, let's say, hardship. And as I continue to speak, I will continue to mention that we can have a one-on-one consultation. My contact information will be much later on, but that is the purpose of talking to a counselor like myself, so that we can individualize and personalize what you might need to accomplish with your credit goals. And again, that goes right to the reestablishing credit if you've had credit problems. Sometimes people think that because they've already paid off their car loan, they just have that credit already established. But if they have no new credit after that loan has been paid off, you have to reestablish credit, because in the credit world, oddly enough, that's considered old news. Although it is helpful and probably built you up to a certain point, you have to continue to keep that credit activity going. Same thing as if, let's say, you fell into hardship and you had to close out certain accounts, or they closed on you, meaning the creditor closed it. You want to be able to reestablish credit. And one of the tips on reestablishing credit is opening up a secured credit card. To my knowledge, Greater Alliance does offer secured credit cards, and that would be a way for you to reestablish credit if you had trouble getting traditional credit from a regular credit card company, or even just a regular credit card through Greater Alliance. So going back to correcting those errors and omissions, the great thing about getting the free copy of your credit report, there are instructions in the back of it on how you can dispute it. So it's typically on the last few pages. You can dispute it by mail. You can dispute it by internet. And the great thing about many of us that have smartphones is you can probably take a picture of whatever proof that you're trying to send to support that dispute. Any supporting documentation that you have is going to help the credit agency, or the creditor for that matter, resolve the dispute that you're putting in. I'll give you another example. Let's say that there's a medical collection showing up on your credit report, and you know you've already satisfied that collection account, but for whatever reason that company just didn't update the credit report yet. Well, if you have copy of your check or your authorization number, any supporting documentation that you can provide is just going to help really streamline that process and make it easy for you to get that error updated and hopefully get that account either deleted or zeroed out. Again, explaining the problem in a brief letter, that's wonderful too, so that you're stating why you are disputing this information. And again, I would say providing that additional documentation to support that letter is always helpful because it shows that there's some type of proof. As mentioned earlier, you can contact the creditor directly if the credit reporting agency does not find the error. And there are times where, unfortunately, maybe Experian, TransUnion, or Equifax doesn't find the error, and then you'd have to go straight to the source. Another great thing about utilizing your free consumer copy of your credit report is that it's going to include not only the names of the companies, but it's going to include phone numbers. It's going to include account numbers, so that if you're not sure of what that bill is, you can call that particular creditor, find out what it is from, whose name it was under, so that you can cross-reference it with your own personal records to make sure you're putting in the dispute properly with enough information to support your dispute. You can also write a consumer statement if the issue remains unresolved. The Consumer Financial Protection Bureau is a government entity that does protect consumers and their rights to working with certain and many financial institutions. And you can go to www.consumerfinance.gov if you wanted to open up a case for them to research. But I would always start with the credit agencies directly, TransUnion, Experian, and Equifax, as well as the creditor before we go to the Consumer Financial Protection Bureau. So the common credit problems, there can be a pattern of late payments, past poor credit performance, bankruptcies, judgments or liens, past due collection accounts, charge-offs, foreclosure, or repossessions. Even if you have had these types of hardships that are appearing on your credit, as time goes by, they become less impactful. So I don't want you to feel that there is no hope. There certainly is. It just depends on what credit problem might have occurred and when it occurred, and how long of a waiting period is required, if any, for you to become a candidate for a mortgage or, let's say, a new loan product. So what can we do to solve our credit problems? Well, we want to prepare a realistic spending plan. That's where that housing counselor might help you, like myself. So before I bought my home, I sat down and I looked at my budget and I identified, okay, how much am I bringing home each month? What are my bills going to be? Or what do I want them to be? That really helped me gauge not only what I could prepare to purchase the home, meaning how much money I could save prior to going into it, but also how I was going to sustain things moving forward after I purchased it. We can also contact those creditors, seek professional help like myself. We want to pay those past due accounts. And we can also negotiate discounted payoffs, which means like a settlement. We just want to make sure that we're aware that there can be tax consequences and that our credit is being updated to a $0 amount. So we don't want it to be updated to a partial amount, if that makes sense. And you can contact a local nonprofit credit counseling agency. I do work for a nonprofit credit counseling agency. So in speaking to a credit counselor, we're not here to tell you what you should or shouldn't be spending your money on. What we are here to help you with is to listen. We're going to identify your goal by hearing what your plan is, what you're trying to accomplish. And then we're going to talk about your existing expenses as they are today. So we'll outline, if this is something you don't already do on a week-to-week or month-to-month basis, we will outline a manageable budget. We'll talk about housing expenses as they are today. We'll talk about utilities, transportation, the necessities such as food and personal items. We'll also talk about any other expenses related to your month-to-month needs and possibly wants. And then we'll also identify what it's going to take to reach this goal if you haven't already identified it. And a big part of having the personalized conversation with a housing counselor, if you already know what you're doing, because maybe you've been doing this research for some time and this planning for some time, maybe it just gives you that reassurance that you're on the right path by talking to another professional. Because as I mentioned, my job is not to tell you what to do. It's to help coach you on how to do it, how to accomplish it successfully. So we're going to determine those options for short and long-term financial goals. We're possibly going to talk about alternative solutions depending on your timeline and when you want to see yourself accomplish homeownership or this next phase in your life. Really more so to help you when it comes to minimizing your debt load and paying any past due bills. Because wouldn't it be nice to move into a new home and really only have the mortgage and those other necessities to survive each month? I know sometimes we have a student loan and possibly a car note, because we tend to have to finance these big ticket items. But I would love to see you move into a new home with no unsecured debt, such as credit cards or personal loans. And we're going to create a realistic action plan. Because again, we want to help you prepare with what's within your power. Everybody has different resources, different circumstances that come up. So we're going to tailor the conversation as to how it's going to suit you, and we're going to set these goals so that they're realistic and achievable. Non-traditional credit. So these essentially are bills that wouldn't normally show up on your credit unless you went bad with them, we'll say, unless they went past due and then got to some type of collection or judgment status. So non-traditional credit are your rent payments. It's your gas, electric, and other utility companies. It's your child care or child support payments. And it's any other large reoccurring expense. So sometimes when you're looking to establish new credit, you can use some of this non-traditional credit to support your credit application. I would say more so with opening up a credit card. I have seen in some cases where certain mortgage lenders will allow you to provide your proof of your on-time rent payment to show some of your credit history. But again, this is very non-traditional. It is not the norm, but it might help you in building on smaller pieces of credit, as I mentioned, credit cards, or maybe a personal loan if needed. So you'll see some things repeated here because I want it to stick, guys. It's so important that when we're establishing credit and we're managing our bills day to day, month to month, that we make sure that our bills are paid first. So for example, when I get my paycheck, my housing payment comes out first. My utility bills get paid. I have to put gas in my car. I put a little bit aside for car maintenance, for my tires, for my oil changes. I have to put food on the table, right? So although some of this is outside of the bill range, it is how I survive every month. And then I identify what I have left over to save for emergencies, to maybe treat myself to a coffee every now and again instead of having it at home every day, okay? We also want to make sure we're opening up a checking and a savings account. Greater Alliance would love if you joined them if you haven't already. So, this is something, again, that's allowing you to do that check and balance system. And if this is new to you, a credit counselor, a housing counselor like myself can help you with this through certain tools. I know some of my clients use Mint. If you have a smartphone, you can download mint.com, like mint that I keep in my purse.com, and it will allow you to even set goals for yourself. And if you're coming too close to, let's just say, that particular goal, it will tell you. Or if you've accomplished that goal, it will remind you, and it will, I'm sure, praise you. So that's the good thing about the technology that we have available to us. But if you're comfortable with just a check and balance system, using a notepad, using, your register through the bank, you can do that too by pen and paper. You can also apply for a loan using savings as collateral. That's called a secured loan. Very similar to a secured credit card, which is also your own money that you're loading on the card. And that's next, that a secured credit card. So even though it's your own money, let's just say you load $300 on that card, okay? That card reports to your credit as a secured credit card, but you still want to use that card conservatively. You want to use no more than $100 if you have a $300 limit, even though it's your own money, and you want to pay it back every month. That is going to be a way to really help your score spike to where you reach that above average range. Above average is probably above a 680. 620 is a low average. Well above average is 740 and above. And these are going to be some of the things we talk about too if we have a future conversation. So rating our spending habits. What would be the easiest to change? Well, I could tell you that there's certain things that I had to change not only upon preparing for homeownership, but sustaining homeownership. So I used to go to the salon twice a month. I don't do that anymore. I've learned to do certain things myself. I used to be able to just take my passport and go to Costa Rica if I wanted to. Luckily, I had the means to do that. I could not do that preparing for a home or sustaining my home. I don't have an endless bank account. So I had to pick and choose what was more important for me. So it comes down to, it's not what's right or wrong, pass or fail, which you'll hear me mention probably time in, time out. It's about how bad do we want it. So if we want it that bad, in most cases, unless we have endless money coming in, we probably have to make sacrifices. So what was the hardest thing for me to change? Not being able to get up and go to Costa Rica like I want to maybe once a year, okay? And you want to ask yourself, is a house worth giving these things up? Well, I could say my personal opinion, for me it was. And I was very scared to buy a home, if you could believe that, guys, with all this experience I have in this field. I must know too much, okay? So it took me many years to really decide that I wanted to plant roots, that I wanted to have this long-term asset for myself as I gain equity and pay down my mortgage, and that's going to be a part of my retirement down the road. So that became more important to me, my long-term goal, than my short-term wants. I'm more so concerned now with a foundation than getting up and traveling. That is where my thought process had to change, and I had to work on retraining my brain so that I became ready to do that at that time. And that's what you want to ask yourself. Are you ready to make the changes now? Or are there other things you want to do first? Again, no right or wrong. It's just going to be a matter of resources and time in regards to how fast or how long this might take. So how do we know if we're ready? Well, we want to know what our credit score is. When you're using a free resource, whether it be through your banking app, Credit Karma, your credit cards, those are all great. But I can tell you those are your consumer scores. They are going to be different than when you apply for a mortgage. When you apply for a mortgage, the mathematical equation is just more strict. Easiest way for me to say this. And I have access to the mortgage score if you and I were to have a one-on-one phone consultation, because we do everything over the phone for your convenience. We will do a soft credit inquiry that does not affect your score, because I do not have any money to lend, but it will help you identify what your mortgage score is. Because like I mentioned earlier, most lenders require a 620 FICO credit score or above. And again, it's going to be different than what you're seeing on Credit Karma or through one of your credit apps. We also want to identify how much do we have in savings, or do we have any gifted money coming from family? Are we eligible for down payment assistance? This is where we come in to personalize so that you understand what different mortgage products require. Some products require you put a minimum of 3% down on the down payment of the purchase price. Some of them require 3.5% down on the purchase price. There are other programs outside of that scope, which again, we would talk about at our personalized meeting. But I wanted to give you an idea that you're going to need to bring something to the table. Even if down payment assistance is available to you or gifted money, most likely you're going to have to bring some type of contribution so that you can show that lender, the mortgage company that's lending to you, that you have had the ability to save. And best case scenario, you don't have to use all that savings buying the home between the closing costs and the down payment amount. Maybe you have a little bit extra in the bank as a cushion so that once you move into the home, if something unexpected comes up, you have a little bit of a reserve account. If we have that personalized meeting, or again, maybe you're playing with the figures on your own with a mortgage calculator, or you've talked to a loan officer in the past, you're going to be able to identify how much of a house you can afford. But just because you qualify for that house, let's say through the lending institution, doesn't necessarily mean that your budget can support it. Because it goes back to the mortgage company looks at your income before deductions. We see our income after deductions to pay our bills. The mortgage company uses a debt-to-income ratio calculation, thinking that according to their calculation, you're going to have enough money to live off of. But I could tell you right now, that doesn't always happen, because depending on the type of house you buy or the other needs you have, sometimes that budget is imbalanced. And we really want it to balance or have a surplus so that you have the ability to sustain the monthly bills, have a little bit extra for emergencies, and sharing, when it comes to, or I should say rather, saving for our long term. So we're going to have a short-term savings, and we're going to most likely have a long-term savings for down the road when we think of eventually retiring. So debt-to-income ratio. That is where the mortgage company is looking at your debts that are reporting on credit monthly, and they are looking at your gross monthly income, and they are figuring out what you can afford for a total housing payment. Total housing payment is your principal and interest, which is your loan. That's based on the interest rate and the amount of years. You've got your taxes monthly, your homeowner's insurance monthly, your PMI monthly if you're putting less than 20% down, and your association fees if you go into a condo, townhome, or planned unit development. And again, this is something that we can talk about. We can do this soft exercise if you choose to set up a future meeting with me. Or if you've already spoken to me, you know that we've done this already, and that we'll continue to do this as you continue to plan if you'd like the ongoing support. So when we're obtaining the mortgage loan, remember I mentioned the minimum of a 620 middle score for all borrowers. At least 3% down as a down payment, plus closing costs. And will we have any extra money left over? And as I just mentioned, that factor includes that gross income, the down payment, and the interest rate. So what is that debt-to-income ratio? It's all debts plus the new housing payment divided by the income. So mortgage payment and costs. I just mentioned what that mortgage includes, right? It's the principal and interest, which is the loan. It's the taxes and insurance. It's the PMI, if applicable, and it's the association fees. And what other costs should you expect? Well, home maintenance, home repairs. I want to be able to keep up with the maintenance on my home. That's how I preserve my equity. That's how I keep up with the value in the neighborhood. And I'm not saying we need all stainless steel appliances or marble countertops. That's not what I mean. I just mean by keeping it up to date, making sure it's not falling apart. Some of the ongoing costs, well, I could tell you that I caulk every year, pretty much. I'm caulking my windows, I'm caulking my trim because the house settles, and I want my house to be as efficient as possible. I don't want all that cold air or hot air blowing in through the walls, depending on the time of year. I want my house to be as efficient as possible, so I'm going to caulk most likely every year. I'm also going to make sure that I'm maintaining my heating and my air conditioning system, because that's how you maintain the longevity of it. That's like $80 twice a year if you get that coupon in the mail. And these are just kind of the basics, right? If we're thinking of almost like maintaining our home. That doesn't include leaving room for error. I moved into my home and my neighbor's unit flooded mine, and not to scare you guys, but it's the reality. So I had to think real hard where that money was going to come from. I didn't want it coming from my emergency savings account a year and a half into homeownership. Even though it was there, I just didn't want to use it. So I changed my personal plans, and I used my disposable income, and I did not go to South Carolina as planned. So I had to make a hard choice because I had to put in a homeowner's insurance claim, and I had no idea what was going to come of it yet. So with that being said, that was a cost that I had to reserve. So again, I was able to use my disposable income, luckily. And the only reason why I had to do it was because it was either that or I had concrete flooring. So I'd like some flooring because I'm on a concrete slab, house flooded. I had to rip up the flooring because otherwise it was going to cause mold and other damages that would have been much more costly. So with replacing the floor, I had to make a life choice and decide not to travel. And that was just, most likely going to be an ongoing cost for my deductible of $1,000. That's how much my deductible is for my homeowner's insurance. So pre-qualified versus pre-approval. So keep in mind that when you are talking to a loan officer, you are giving them your good faith word, okay? That's where that pre-qualification comes in. How much will they possibly lend to you? What price range you can afford? How much your monthly payments are approximately going to be, but there's no guarantees until you actually submit your paperwork and you back up that good faith word, right? Then we start applying for the loan. Then this is going to guarantee that the lender is going to provide you the loan that you had in that informal discussion. And sometimes there is a small fee involved. In most cases, it's on the smaller side. Usually I see around a few $100s. Greater Alliance certainly can advise you specifically if they have any fees associated with originating a mortgage. And they're going to talk about the housing ratio with you. That is going to be the maximum percentage of that gross monthly income that can be used for a monthly mortgage payment. The debt to income ratio, that's how much of a monthly payment can be used for the housing plus all other debts. So you've got your front end and your back end debt ratio. And I don't want you to feel that you have to memorize this. Loan officer walks you through this, housing counselor as myself, we walk you through this calculation so that you can identify what would possibly make sense for you. So we've got some ratio examples here. They like to see that your housing ratio is about 33%. They typically don't want to see that those other expenses on credit are exceeding 50%. But you'll see this pie chart is just simply a ratio example, okay? So what are the advantages? Well, we've got stability, right? I know where I'm going every day. I've got the tax benefits. I got a $25 tax credit from purchasing, by the way. Maybe you guys will get a different one, depending on where you purchase. You have control over your environment. If you have a single family home, you have the ability to make those changes inside and out. Condo, a little different, but still much more flexibility than having to talk to a landlord. You're going to gain that equity over time. Some of the disadvantages, well, we've got those monthly costs, right? We've got this responsibility now, this mortgage in our name. And there's no guarantees that our value is going to increase. We've got the maintenance and repairs. We're in a position where we're grounded, maybe decreased mobility, depending on if you wanted to sell. Sometimes it could take a little bit of time, depending on the market. And fewer features. So shopping for a loan, you can shop online, you can talk to Greater Alliance, of course, you can look for other community resources, as I mentioned earlier, down payment assistance programs, consult with a housing counselor like myself. Not all loans are what they appear to be, so you want to compare loans. Things are a bit different nowadays. Interest rates are only a part of the loan offer, but you've got, your interest rate, your closing costs, the length of the loan. Are you taking out a 30-year loan or a 20-year loan? Payments are all factors which will help you identify what's going to be best for your circumstances. And be aware of any prepayment penalties. I don't commonly see this nowadays. That would be if you paid off the loan previous to a certain period of time, there'd be a charge. And you could go to www.bankrate.com to try to play with some calculators. But keep in mind, most mortgage calculators only include the loan. So you have to calculate in taxes, insurance, private mortgage insurance, and association fees if applicable. You want to beware of any predatory lending. Anything that sounds too good to be true probably is, but I could tell you that some of these loans, I don't know if I should call it predatory, but some of these no income, no doc loans are back again. But be mindful that, you know, if I can't qualify based on my income, can I really even afford this loan? So, you know, I always say that it's best to go the documented and verifiable route, and that's what Greater Alliance uses here. And most lenders still use those products. There's a few and far in between that allow for those high interest rate types of loans. That's where like a predatory lending loan comes in, where it's a really above market interest rate. So you've got your homeownership team, you've got your housing counselor, your lender, your real estate agent, your attorney, escrow officer, title insurance, housing inspector, appraiser, surveyor, insurance agent, just to name a few. So when I tell you guys, everybody wants to get the deal done. So they will be walking you through this process after you go through your mortgage pre-approval. So with the loan processing aspect, you know, they order and review the credit report, they mail the verifications of employment and deposit, they'll calculate the ratios, they order appraisal, just like what I said. They're going to walk you through this process because everybody wants to see you get to the closing table. But why could we possibly be denied, right? Well, maybe we have high debt, maybe we don't have enough money, maybe the appraisal doesn't come back right, or there's a poor credit rating. And these are the things too that I prepare you for. We talk about like worst and kind of best case scenario when we're having our consultation. But sometimes you can get some conditions, meaning once you're going through the buying process, you know, there are things that are researched through that buying process. And these are just to name a few. There could be a property condition contingency, meaning you need a certificate of occupancy from the town. Documentation contingencies, maybe the lender's still waiting on a pay stub. The sale of the existing property, paying off the debt, and resolving legal problems. That would be if you had to clear anything up before you could obtain the actual loan. And we've got those closing costs, the loan fees, interim interest, insurance premiums, and escrow account deposits. I will talk to you, depending on what it seems like you might qualify for, how much those closing costs will be in the tune of. So I do understand those approximate figures. So how do we prepare for closing? We do a final walkthrough the day of. We get that closing disclosure, it's called, or that closing statement at least 3 days before going to the table. We're most likely wiring the money to the title company to close instead of that cashier's check. We're signing the mortgage papers at closing, and we are setting up our utilities. And then we've got some closing documents listed here, guys. Again, I don't expect you to memorize any of this. This is just to let you know that you will be signing a ton of paperwork at closing, but you will also get a copy of it. That is the great part of closing. You get everything for your records too. And now I've got my contact information listed here. I know we've used quite a bit of time, so I thank you for your time with me. And again, my name is Stacy. You can reach me at the 866-472-4557 at extension 80495. If you don't have the means to save this information, Greater Alliance does have my contact information as well. And there's future webinars, guys. Greater Alliance would love for you to join. As you see that they're listed below here, you could go right online to www.greateralliance.org/webinars to register. You've got the Millennial Home Buying Guide, Tuesday, October 1st. What is better, home equity loan or home equity line of credit, Thursday, October 10th. And when or when not to refinance your mortgage, Wednesday, October 23rd.
Yep. So now we're going to open it up for the Q&A section. So you should on your computer have an area for questions. So feel free to ask any questions. Now is the perfect time to ask that. We have one here. We actually have a few. So What if I am a couple of days late with the payment? Does that affect the credit score?
So it's going to be dependent on if you've reached that 30-day late mark. But I would say if you're a few days late and you're just, dealing with a late fee, I would say in most cases the creditor is not reporting yet. You just have to make sure you're not at that 30-day mark, and you could certainly ask the credit company that where you are.
Another question we have is, how do people get a credit score of 850?
It's just multiple diverse accounts. It's how long you've been in the credit world and how conservatively you might be using it. But I can certainly advise you of that more so when we have our tailored conversation one-on-one.
Another question here, how long does a charge-off or poor credit performance stay on your credit card report?
So 7 years from the first date of delinquency, those old bills should be falling off. And if they're not, you could dispute to get them removed.
All right. For example, if I make $180,000, is that $100,000, how much debt can I have before I can purchase a home?
That's a great question, but I think we need to have a more so personalized conversation. It's just going to depend on, the type of price range you're looking in and how much debt you're currently carrying. But that's a great question, but more so we want to tailor that personally for you.
All right. Is there any other questions? I don't see anything here. I do want to mention during the presentation, Stacey mentioned that we have credit cards. Greater Alliance actually does not have credit cards. I just wanted to make that. Yeah, that's okay. I just wanted to make that known. We do offer secured savings loan and CD secured loans. So if you are interested in some sort of investment, feel free to do that. But we do not offer credit cards. So I just wanted to clarify that. And also, we do have a system called Money Management, which is a tool that we have available to all members, where if you want to manage your budgeting or your finances or anything related to your home budgeting, we have that available for all members. So again, if you have any questions and you didn't have time to answer it during this presentation, feel free to always reach out at us. You can email us at info@greateralliance.org, and we always have someone who's available to answer any questions you have for mortgages or just any questions regarding, your banking. So I appreciate your time and taking the time to watch and listen to this webinar. Thank you for Stacey. Thank you for Stacey for coming and giving such an amazing presentation. She really is a resource that if you have any questions, you want to take advantage, because you won't find too many people with more knowledge of the industry. So thanks again for coming, and we hope you have a great rest of the day. I also want to mention, if you're still on the line, sorry to keep going, we have a survey right after the webinar ends. You'll actually get a prompt for a survey. If you fill it out, we would really appreciate it. It really helps us make these webinar experiences better, and you have a chance to win a $25 gift card. So definitely check that out if you want to win, and then we really appreciate that. And then just last thing is, thank you for attending. Follow us on Facebook, Twitter, YouTube, and Instagram, and we look forward to seeing you at our next webinar on October 1st.